In this video, I'm going to look at this Yahoo Finance article about their grim prediction for the housing market, and we will also look at the latest S&P CoreLogic Case Shiller Index report for 2021. Hey guys, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Welcome to the channel. I saw this article on Yahoo Finance and the headline reads, quote, "One expert's grim assessment of the US housing market," unquote. Now when I saw this, the first thing that came into my mind was, oh no, not another ReVenture Consulting video. If you don't know who or what ReVenture Consulting is, check out his YouTube channel. It's basically all doom and gloom real estate news. He says he's data driven, but the thing is, the way he reads or interprets the data has a very negative slant to it. Anyway, let's look at the Yahoo article. It started off with this: mortgage rates surged to the highest level in 2 years, leaving home buyers on high alert as further increases loom. This is absolutely true. Mortgage rates, as I shoot this video, is now over 4%. Weirdly enough, because of this, home sales surged in January as buyers went out there frantically trying to lock in low rate. In fact, according to the National Association of Realtors, the latest existing home sales report, quote, "Existing home sales rose in January, making a notable move upward following a previous month where sales declined," unquote. On a month-over-month basis, all the 4 major U.S. regions experienced an increase in sales in January. However, year-over-year activity was mixed. 2 regions reported lower sales, another one increased, and the 4th region remained flat. All this buyer activity, or maybe I should say buyer frantic activity, was most likely because of mortgage rates going up and continues to go up as most buyers wanted to lock in rates now. Because of all the activity, we had a surge in sales. It didn't help that inventory was still nowhere to be found. Total housing inventory at the end of January amounted to only 860,000 units, down 2.3% from December, and down, get this, a big 16.5% from 1 year ago. According to NAR's chief economist, homes priced at 500,000 and below are disappearing, while supply has risen at the higher price range. He noted that such increases will continue to shift the mix of buyers toward high-income consumers. What this means is that there are not enough houses out there for first-time buyers or lower and mid-income buyers. Also, it means that if moving forward, we don't see any of these entry-level homes either being built or getting more resale inventory, all we're going to see are higher-priced homes. The article continues on. According to the CEO of DLB Financial Services, CEO Debbie Boyd, quote, "Things aren't going back down, so we have to quit thinking this is a bubble and just start thinking that this is now. This is the real thing," unquote. She is spot on with this viewpoint. You see, let's not even talk about a bubble. Get that out of your head. Let's just talk about what is going on right now. Depending on what data you're looking at, we have a housing shortage that's between 4 to 5 million. Let's just call it 4 million. Nothing is being done to address this right now, meaning there are no 4 million housing units that's coming on the market this year, next year, or even the year after. To further compound this problem, millennials are coming into their prime home buying stage. These are the people that are starting their family and wants to buy a home. That pool of buyers is not going down. They have been the largest home buyer since 2014. And as if that weren't enough, we now have Gen Z buyers coming down the pipeline. In probably another 3 to 5 years, right now, they only represent about 2% of home buyers. But when they come into full buying power, there are about 68 million Gen Z out there. If only 5% of those are home buyers, that's another 3.4 million. Now, where are we going to come up with another 3.4 million homes on top of the 4 million that we're already short? This is why prices are going up and every home that hits the market is selling fast. The median existing home price for all housing types in January was $350,300, up another big 15.4% from January of 2021. This price increase marks 119 consecutive months of year-over-year increases, the longest running streak on record. Chances are, next month, we go 120 consecutive months of increase, even with mortgage rates going up. Now, the hope is that higher mortgage rates will slow down this very heated real estate market. There is concern out there about all these mortgage rate increases. The segments that will most likely be affected are moderate income buyers who probably were already having a hard time qualifying before, even with the low mortgage rate. In expensive markets like here in California and New York City metro area, chances are it will also start getting a little harder as those monthly mortgage payments will be a lot higher. Personally, I think here in the Bay Area, it won't matter much as I see most buyers will just bring in more down payment, at least those that can afford it. So you might be thinking that this would probably slow down buyer activity, right? The way I see it, there's still a lot of home buyers, not just here in the Bay Area, but nationwide that has enough cash to weather interest rate hikes all the way up to 5%. But if you asked me last year if I thought we see rates as high as 5% early in 2022, I would have told you you're crazy, but that's actually happening now. If any of you are wondering if we are going back to those sub 3% mortgage rates, that is not likely happening in the foreseeable future. The Feds may be hiking rates 3 or 4 times this year, and every time there's a rate hike, the Treasury yield goes up, and when the Treasury yield goes up, mortgage rates follows. Everybody is so concerned about this, and part of me thinks rightfully so. But I also believe, as I mentioned earlier, that the real estate market could withstand these rate hikes. Clearly, we've been accustomed to historical low rates, which in turn help drive demand. But with these rate hikes, most home buyers are feeling a little dejected. But the housing market has remained and should remain hot. I'm a firm believer that when and if someone wants to buy or sell a house, one will find a way to accomplish those goals. As I have said earlier, to offset these higher mortgage rates, higher down payment, or maybe buying at a lower price point, even looking elsewhere is an option. So that Yahoo article about doom and gloom part of the article was mostly about rising mortgage rates will only make it more expensive to buy a house. And even with these rising mortgage rates, home prices should continue to go higher. And you know what? That is true. What will happen is if you don't pull the trigger now, you will just end up paying higher later, or worse, not be able to afford to buy anymore. So when you're making offers out there, be aggressive or pay more later. Now the latest on the S&P CoreLogic Case Shiller Index. This shouldn't come as a surprise, but according to their index, in 2021, annual home price gain was a whopping 18.8%. This is the highest in the last 34 years. If you're wondering how 2020 compares, in 2020, we ended the year up 10.4% according to their index. The highest appreciating areas are as follows. Phoenix at 32.5% increase is number 1. Phoenix has been on the top spot for 31 consecutive months. Tampa at 29.4% is the second, followed by another Florida city, Miami, 27.3%. Regionally, prices were strongest in the South, up 25.7%, and the Southeast up 25.6%, but every region continued to log impressive gains. Now, while these prices or these increases look very high, they noted that it's decelerating, meaning slowing down. Here's what they had to say about the report. Quote, "We have noted that for the past several months, home prices have been rising at a very high but decelerating rate. The deceleration paused in December as year-over-year changes in all 3 composite indices were slightly ahead of their November levels. December's 18.8% gain for the national composite is the 5th highest reading in history." Unquote. This is what most experts are predicting for this coming year, 2022, and for 2023, 2024, and 2025. Home price appreciation should slow down their rapid pace. No one is saying prices are going down, okay? Price appreciation will slow down, and from what their data is suggesting, it seems like it might be starting already. I believe that this is true and correct when you look at the national or broad market as a whole, because one fact remains true. We do not have enough inventory out there to meet the demand. This will be the driving force that keeps the prices from crashing. So if you're looking to buy a home and waiting on the sidelines because you think the stock market, the mortgage rates, or these geopolitical issues happening will drive home prices down, well, it's probably not happening anytime soon. I suggest going out there and just being aggressive with your offers, because like I have said, you will most likely pay higher prices down the line. What looks like expensive right now will be more expensive later, either in actual home price or your monthly mortgage payment via higher mortgage rates, or both, most likely both. Hey, thanks for watching. Hey, I'd appreciate it if you can click the like button, and if you want to share the video, that'll be great too. Have a great day.